April 2nd, 2025, Rose Garden, White House. Donald Trump stood at a podium holding a large printed chart. He called it Liberation Day. He promised jobs and factories would come roaring back to America, that prices would fall, that this was the day the United States began to make itself wealthy again. Within hours, global stock markets fell. Within 7 days, Trump reversed course, pausing most tariffs for 90 days while leaving China facing a 145% rate. 1 year on, the data is in. There is one outcome from the tariffs that almost nobody in the administration publicly predicted, and it is the most important number in this entire story. We will get to it.
To judge whether the tariffs worked, you need to understand what they were supposed to do. The administration stated 4 specific goals, publicly and repeatedly. Bring manufacturing jobs back. Reduce the U.S. trade deficit. Generate federal revenue. And use tariff threats as leverage to extract better trade deals. The tool was sweeping. A 10% baseline tariff on nearly every country on Earth, with higher rates for 57 specific nations. For China, it escalated to 145%, the highest tariff the U.S. had applied to any major trading partner in the modern era. The average applied U.S. tariff rate peaked at 27%. The last time American tariffs were this high was 1909, more than a century ago. What happened in the 7 days between April 2nd and April 9th tells you almost everything about how the rest of the year unfolded. It started with one number on a screen. On April 9th, 7 days after Liberation Day, U.S. stocks were falling, bond prices were dropping, and the dollar was weakening simultaneously. That is unusual. Investors do not normally exit stocks, bonds, and the dollar at the same time. They appeared to be moving out of U.S. assets entirely. That morning, Trump posted on Truth Social that the higher reciprocal tariffs, those above 10%, would be paused for 90 days for all countries except China. Markets immediately reversed. Over the following year, U.S. tariff policy changed more than 30 times, according to Yale Budget Lab, which launched a daily tariff tracker to document what had become genuinely difficult to follow. Then, in February 2026, the Supreme Court ruled 6-3 that the IEEPA authority Trump had used to impose the Liberation Day tariffs was not legal. The government had collected $166 billion from more than 330,000 businesses under a legal authority the Supreme Court found unconstitutional. Those funds are being refunded. Trump responded by imposing a new 10% global tariff under a different legal authority. The architecture that began April 2nd remains in active legal and political flux today. Against that backdrop of reversals and legal defeats, here is what the 4 stated goals actually produced. The results are not what either side of this debate typically claims. And the country that came out of 2025 in the strongest trade position? It was not the United States. Goal 1: manufacturing jobs. Manufacturing employment declined in 8 of the final 9 months of data following Liberation Day. Between April 2025 and February 2026, U.S. factories employed approximately 75,000 to 89,000 fewer people than when the tariffs took effect. The White House pointed to a manufacturing survey showing activity expanding for 3 consecutive months into early 2026. But the same survey's prices index hit its highest level since 2022. Manufacturers were expanding while absorbing significantly higher input costs. Verdict? Manufacturing jobs declined. The headline promise was not delivered in year one. Goal 2. The trade deficit. This is the most counterintuitive result. The goods trade deficit rose approximately 2% in 2025 to $1.24 trillion. Total U.S. goods imports reached $3.4 trillion, up approximately 5% from 2024. The primary reason? Companies front-loaded inventory purchases in early 2025 before tariffs took full effect, pulling forward demand that inflated the figures. U.S. exports also rose, up 6% to $2.2 trillion, but the deficit widened regardless. Verdict: the trade deficit grew, not shrank. The most publicly stated justification for the tariffs produced the opposite result in year one. Goal 3. Federal revenue tariffs generated tens of billions of dollars in federal revenue across 2025. But $166 billion of those collections, gathered under IEEPA, were ruled unconstitutional and are being refunded. The net revenue picture after refunds is significantly smaller than the gross figures suggested. Goal 4. Trade deal leverage. By April 2026, the United States had initiated or completed bilateral framework agreements with more than a dozen countries and the EU, generally focused on agricultural market access and reducing specific tariff barriers. Whether these represent durable improvements or temporary arrangements tied to a partially invalidated tariff regime remains genuinely unclear.
The tariffs were designed to weaken China's trade position. China ended 2025 with a record $1.2 trillion trade surplus, the largest in its history. As U.S. soybean exports to China fell 78%, and corn exports to China fell to near zero through August 2025, Brazil stepped in. Its exports to China hit a record approximately 82 to 84 million metric tons, up approximately 14%. Argentina roughly doubled its soybean sales to China. The markets the U.S. lost did not disappear. Other producers absorbed them. AlixPartners found that automakers were expected to pass approximately 80% of tariff costs on to consumers, with companies absorbing the remainder through margin compression. General Motors alone absorbed $3.1 billion in tariff costs in 2025. Food prices in the United States rose 2.8% from all 2025 tariff actions combined. Economists estimate the peak consumer price impact arrives between April and October 2026, lagging implementation by 12 to 18 months. The full price effect has not yet been felt, which brings us to the question the title is actually asking. And the honest answer is more complicated than either side of the political debate will typically acknowledge. Did it work? On the four stated goals, manufacturing jobs declined, the trade deficit grew, the revenue collected under the primary legal authority is being refunded, and the country the tariffs were most explicitly designed to pressure ended the year with its largest trade surplus on record. The tariffs did change the trade conversation permanently. They did force companies to rethink supply chain dependency. They did bring 18 countries to the table. Whether that is worth the price increases, the legal costs, the $166 billion in unconstitutional collections, and the friction with allies, that is not a question the data alone can answer. What the data does answer, cleanly and without political interpretation, is that the specific, numbered promises made in the Rose Garden on April 2, 2025, did not materialize in year one. The tariff story is not over. What is already clear is that the global economy does not hold still when tariffs are imposed. It adapts. It reroutes. and the adaptations often produce outcomes nobody publicly predicted. That dynamic connects directly to our previous video. China just banned the metal inside your phone's chips, which covers how China used export controls on critical minerals as its own form of economic leverage. Watch that to get the complete picture of this trade war from both sides. One thing I would genuinely like to know: do you think tariffs at this scale can ever durably shift manufacturing back to the United States? Or does global supply chain economics make that structurally unlikely, regardless of the rate? Drop your answer in the comments. If you want the structural picture behind the headlines, on trade, geopolitics, and the decisions reshaping the global economy, subscribe. That is what this channel is built for.